I'm Charlotte McLeod with the Investing News Network, and here today with me is Daniella Dimitrov. She is a mining finance executive, a corporate director, and she spent a lot of time in the capital markets. Daniella, thank you so much for joining me today. It's great to see you.
Thank you very much. It's great to see you coming off of a couple of successful industry conferences to get us started in 2023.
Yes, and I had a chance to see you speak at Roundup, which is one of the conferences that we just made it through in January. So we're going to pick up on some topics that you discussed there. What I wanted to start with is kind of to get your take on the state of financing in the junior mining sector. So you had spoken about kind of a shift that we saw from 2020, 2021 into 2022, which I thought was really interesting. Could you expand on that?
Sure. I talked about at the conference that there are about 2,700 or so companies in the mining sector, and about 2,500 of these are juniors. So over 90% of the industry is either focused on resource discovery, de-risking development stage assets, establishing production, or growing production. So there are a lot of companies in our industry looking for a lot of capital at any one time. A lot of juniors are focused in the precious metal space for a variety of reasons: less capital intensive exploration, less capital intensive development costs, more approachable CapEx, more approachable infrastructure costs. Ultimately, you can actually just fly the gold bars out if you're building a gold mine in the jungle, whereas if you're building a copper mine or a base metals mine where you're producing bulk concentrates, you've got to truck those out to the port. So infrastructure and logistics matter a lot more in the base metal space, and those are very capital intensive. In the last 24 months, with a focus on energy transition, critical metals, we have seen the creation or more material progression of juniors in the copper and critical metal space, such as cobalt, nickel, graphite, lithium. So focusing on gold juniors, and let's just talk a bit about that. In the last 5 years, the gold price has gone from a low of 1176, I believe, in the second half of 2019 to a high of almost 2,100, and has really been on an upward trend that started in that second half of 2019. We've reached that peak of almost 2,100 in the second half of 2020. So through this excitement of gold price increases, we did see a lot of juniors finance, particularly in the gold space, and often more than once, and often at higher prices in subsequent financings or a better cost of capital. So for example, they financed based on a unit with warrant or half a warrant, and were able to achieve a financing without warrants on a subsequent financing in that time period that I talked about. We saw funds flow into the mining sector in this period, including from some generalists. We saw shares in diversified mining companies such as Rio, BHP, Anglo, Glencore almost double in this period of time. So there really was a shift in the second half of 2019 to 2021 because of what was happening in the space, the environment, rise in commodity prices, supply chain challenges, et cetera.
I think that's a really great recap of where we are today. And of course, the next question is, how is 2023 looking? Because anecdotally, just from conversations that I've been having, it does sound like it's still a little tricky for juniors to raise money.
Absolutely. 2022 certainly brought a change, and we saw that shift in sentiment. We saw the shift in capital drying up in our sector. We saw the debt markets close with interest rates going higher through 2022. And we also saw equity prices that I've talked about that had doubled and reached highs in 2020 or in the first half of 2021 be down 40–50%. So companies that have a lot of stability, certainty, that were generating great free cash flow, that had delevered, that were returning capital to investors through dividends and share buybacks. We saw their equity prices decrease by not insignificant amounts. So of course, that really almost froze the capital allocated to explorers and juniors, whether it's explorers or developers in our space. We started to see a window open in the second half of 2022. I talked about a number of financing packages that were put together by developers and construction decisions announced in 22. So we saw some producers that are going ahead with builds of another asset in their portfolio, having secured financing, such as Eldorado, continuing to build their asset in Greece, such as Torex, announcing a construction decision for their Media Luna asset in Mexico. And we also saw a number of single asset developers that were able to construct financing packages in 2022 and make construction decisions in the fourth quarter, such as Sabina, Marathon Gold, Ascot, Artemis, all with development assets in Canada and all single asset developers, and also in other parts of the world, such as G Mining, making its construction decision on its asset in Brazil after having put together a financing package of almost $500 million. So knowing that we were going to chat today, I just wanted to share with you and your viewers some examples of financings that were announced or completed in the last 48 hours alone. Silver Mountain Resources raised $9 million. Paycore Minerals raised 18. Canada Nickel, on the back of Anglo American taking a 10% interest in the company for $24 million, announced $20 million financing. Encore Energy, $34.5 million. Rupert Resources, almost $50 million. Vizsla closed on its $45 million financing. Go Gold closed on its $65 million financing. Silver Tiger announced an $18 million financing, and Osisko Mining announced a $75 million financing. That's just some examples of the announcements that we've seen literally in the last 48 hours. So definitely a much better sentiment coming into the first quarter of 2023, and with capital being allocated into our space.
Wow. Well, thank you for putting together those examples. I think that really highlights what's happening right now. You've gone through some of the trends in which companies are able to get financing right now. Is there anything else you would pull out in terms of commodity that they're focusing on, jurisdiction, any other points?
Yeah, so if we walk through the examples that I just gave, we're certainly seeing capital continue to be allocated in the precious metal space. A number of those junior companies that I've just mentioned are in the precious metal space, and most of them, if not all of them, are either explorers or continuing to progress their exploration assets towards development, such as Osisko Mining, that is continuing to progress its Windfall asset that has economic studies around that, as well as a well-defined mineral inventory. So from a metal perspective, but some of the other companies we've seen capital go into nickel. Encore is a uranium explorer. So we certainly have seen some capital go into the critical metals industry, and I'd put uranium up there with all of the talk around energy transition and the role that nuclear can play in the clean energy space. So from a metals perspective, continued focus on precious metals with some capital allocated to critical metals. And from a jurisdiction perspective, we're also seeing diversity there. A number of the companies that I've talked about have exploration assets in Mexico. We have seen one of the financings go to silver in Peru. notwithstanding the unrest that we have seen in that country over the last number of months. So from a capital allocation perspective, we're seeing some focus on and some focus on geopolitics. Of course, that's a risk we always talk about and keep an eye out on our industry. But we are seeing capital allocated across the space in various jurisdictions. I think one of the other things to keep in mind here is capital gets allocated by capital providers that vary anywhere from resource funds such as Franklin, Merck, 1832, PE funds, pension funds that might invest directly in our industry or indirectly through one of the PE funds or other resource funds. And it's important to note the sentiment of these capital providers. And we talked about 22 being uncertain. We saw a lot of volatility in both the debt and equity markets. We saw a lot of volatility in the commodities space. And when we see that capital may migrate towards those investments that are more stable, more certain, that may not have a high growth profile, but certainly that may have that stability of, cash flow generation, and that can withstand, the highs and the lows. And what we've seen at the beginning of 23 is capital starting to be allocated back into those opportunities that may be a higher risk, but may offer a higher growth profile than, for example, some of the majors that I've talked about. So sentiment of the investors is definitely important on that front. And then maybe one other comment is that we're seeing different capital providers enter the space, and from governments, from automakers and other third parties that we would not have seen 5 years ago. And in the last week alone, for example, we saw GM make an equity investment or announce an equity investment of $600 million into Lithium Americas to progress the development of their asset in Nevada. And we also saw GM as recently as this morning talk about its plans that it is considering a 10% investment in the base metals arm of Vale that could be worth up to $2 billion. And that's not something that we would have seen or talked about, 2, 3, 4 years ago. So we're definitely seeing new pools of capital coming into the critical metals space.
Yeah, that's really interesting. And it's definitely one of the points I wanted to ask you about, because it came up in your roundup presentation as well, that kind of divide between traditional and non-traditional sources of capital for companies in the mining sector, including juniors. So is there anything else that you would add on that topic?
Certainly in terms of juniors, equity investors, whether that is from the traditional funds, high net worth, retail investors, or maybe another miner taking a toehold equity interest in a junior. Those have been the traditional pools of capital that have allowed the explorers and developers to really move their assets forward. We have seen other forms of financing in the junior space at the exploration stage, certainly at the development stage, but maybe even at the exploration stage, such as streams, such as royalties, such as sales of offtakes coming in ahead of an asset being ready for a construction decision. And we've seen that happen when the equity markets have been closed or not so open, like maybe we've seen in 2022 or before 2019. When the equity markets and the junior space really started to open up. Or we've seen those types of financings in the exploration stage coming into play where there may be concern around dilution and a real concern that maybe the market isn't fully recognizing the value that is there. And of course, everyone thinks their company is undervalued at any one time on that. And I think when we see that, and when management teams think about those more non-traditional sources of financing coming in at an earlier stage, one really needs to make sure that you provide for the flexibility to add financing sources of different structures as you move the asset forward. And so as you get to a construction decision, everyone is going to be looking for security, for priority, to title, to cash flows coming out. And if you don't provide for those types of things early on, when you do that first royalty or you do that first stream, you're going to have some structuring challenges going forward. So maintaining that flexibility, certainly is important with non-traditional sources of financing coming in at an earlier stage.
Really interesting. And another topic I want to go over is kind of the role of generalist investors in all of this, because I hear a lot of the time when generalists come in, that's when the sector is really going to take off. But on the other hand, they might want to go other places. We know that ESG is becoming really important for all investors. And for generalists, they might look at the mining sector, although of course we know that companies are taking it very seriously. But generalists who don't know as much about the industry might want to go somewhere else. So maybe if we could talk about generalists and the role of ESG when it comes to financing.
Sure. A couple of comments around generalists. Certainly in 2020 and 2021, when we were on an upward trend, certainly with gold prices, when we were seeing a lot of activity in the space and capital flow in the space, we were seeing, and at that time I was at Sprott as an investment banker, and there was a lot of financings that were done in the space by a number of the investment banks in our capital markets industry. And you were seeing pretty well the same number of accounts coming into a lot of the financings that were being done at that time. And although we did see some generalists come into this space in 2020 and 2021, it certainly was not to the same extent that we all had hoped. And now going into 2023, we are talking about the generalists coming again. There is a lot more focus on energy transition, the critical metals that are needed to get us there, including copper. And, hopefully our industry itself presents a better picture over the last few years than maybe we did back in 2015 to 18, from the perspective that we can create value beyond the commodities prices going up, that we can maintain discipline on costs, that we can maintain discipline around capital allocation, that a number of the producers have returned capital to shareholders through dividends or normal course issuer bids or both, and that we can build on time and on budget, although I think we really do need to continue to focus on capital projects execution as value creation in our industry and continue to do a better job from that perspective. So hopefully the industry itself in 2023 can present a better picture, than it did maybe 5 years ago. So certainly we are talking about the generalists, and we continue to talk about that. You talked about ESG. This is obviously no longer something that's just expected of the big companies. Explorers, developers, of course, producers are expected by capital providers to successfully implement sustainability initiatives. So certainly at the project development stage, but even at the exploration stage, because if you don't get started on the right foot, you're going to have challenges going forward as you move through the various life cycles of through explorer to developer and so on. And we have seen that in our industry, that if you don't get started on the right foot, you're going to have challenges later on. So certainly projects that have appropriate sustainability programs and that meet certain standards are more likely to attract interest from a wider range of investors than if you don't come at it in that way.
Okay. And, looking at all of this from kind of a retail investor perspective, I think people are often told to look for companies that have cash in the bank, and this is a positive. But of course, we know that not all financings are created equal. So I wondered if you could go over some red flags and green flags when it comes to financing, things that people should keep in mind.
Certainly. When you look at an opportunity to invest, whether that is with a company that's doing an equity financing, so you're buying shares from Treasury, or you're looking to invest in the secondary market, so in the public markets, certainly take a look at a number of things. One is, what kind of volatility has there been, and how has that particular story, that particular company, how has it performed against its peers? Does it move up and down with the metal prices? Does it move up and down as other ones of its peers are moving up and down? What's happened to the stock price in recent times prior to the financing or prior to you coming in to invest? Are there opportunities to jump in because something has happened in the region that has impacted that particular name, more so than it otherwise should? When was the last financing done? When did this company last issue shares from Treasury to investors? At what price? And what did management do with that capital? What progress has been made? What has been the G&A? How much cash are they burning? How much money is going into the ground versus in sustaining the overall G&A of the company? And how does that compare, with others? And if you're buying from Treasury, is there an equity sweetener? Is there half a warrant or a warrant that's attached, that's, priced attractively? That will allow the investor to maybe have an upside and the opportunity to purchase shares at a price in the future that may be sort of easily achieved. We are seeing out of the names that I mentioned that have announced or completed a financing in the last 48 hours. We're seeing junior companies that are financing today from Treasury at prices that are equal to financings that they had done either back in the second half of 2019 or in early 2020, notwithstanding the fact that the capital that they raised then has been used to further de-risk the asset and progress the asset. So a company that may not have had a mineral inventory reported, in early 2020 and financed at a certain price that may now have a resource estimate, we're seeing, the prices being, almost in line to that. So, there's certainly opportunities in the space, but just make sure that you do your homework. And you look at all sorts of factors when you assess the risk that you're going to take.
Definitely, I think due diligence always important. So thanks for going over that. It really sounds like the environment for financings is looking quite positive right now. But I did want to ask, in times when it's tougher, how can juniors, what strategies should they use? I'm kind of curious about that. Should they be trying to lie low? Should they try to raise a lot of money at once to see them through? What do you think about that?
Yeah, it's always the dilemma, and it's always a conversation that one has. Someone said to me a long time ago when I got started in my career that when they pass cookies, you take cookies. And what I mean by that is, you never know when the market's going to turn. You never know how long the window is open. And I appreciate that everybody, again, thinks that their company is undervalued, and you don't want to dilute more than you have to, because you want to take only the capital that you need over that 12-month period, because you want to then invest that capital, generate results, see a re-rate in a sense, and then access the capital markets again at a higher price. But as we have seen over the time and time again, the windows come and go, and you can't quite, time the market, because if we all knew where the market was going, then I think we would all be maybe better off in a sense. So I would say, from my viewpoint, take more capital than you think you need. Have some capital available for a rainy day. Think beyond that next immediate milestone in your life cycle. I am going to drill 6 holes and I'm going to get the results and they're going to be great. And then when I put those out, my stock's going to re-rate and then I'm going to access the markets again. So think about, all of the milestones on that. I don't know that I have heard a lot CEOs looking back and saying, boy, I wish I hadn't diluted as much as I did at that, price point. I've seen, capital being taken, capital being used to then, generate results and create value. And it's great to have additional capital there for a rainy day so that you can put that to work when the capital markets might be closed. A couple of other things that I've come across in my path, which I really emphasize, particularly with juniors, is be ready. And what I mean by that is have a data room set up, keep it up to date, have your own NDA that's ready to go, have an AIF filed, have a base shelf cleared, know your neighbors, have good relations, have clarity around what your ESG or your sustainability program is. And you don't necessarily need to be reporting against all the standards of GRI and SASB and TCFD like the majors, but have the clarity of your own programs, your own data, what you're doing and what your path is at. Consider your capital structure, know your programs, think about how you're going to allocate capital along your journey on that. And of course, make sure that your board of directors is up to speed. So in other words, do everything that you can to be ready so that you can jump through that window when that window opens up. And make sure your story, have a story, be a good storyteller, practice your story, go tell your story to sales desks on the street and ask for their feedback. I've seen management teams in the industry where you're not really sure what the story is, how the value is going to get created, or it takes quite some time to get the story out. And sometimes, the investors only have a limited time to, for you to deliver that story. So I can't stress this enough. Have a story, be a good storyteller, and get as much input into your story from people that hear, 5 stories every day.
That all makes so much sense. So I want to talk a little bit more about current events. You've been mentioning some of the things that have been going on over the past 48 hours. We also have another big proposed transaction in the gold space between Newmont and Newcrest Mining.
Yes.
So one thing that I hear a lot about those big gold mega deals is that gold companies want to get big, because if they do that, they can get access to larger pools of capital that they wouldn't have been able to access before. So I definitely wanted to get your take on that.
Sure. It's easy to lose maybe track of the total size of our own industry and how that compares to other industries, and the size of the largest companies in our industry and how they compare to other industries. And the market cap of, a Barrick, let's say, is something like $40 billion. And I think the combined market cap of Newmont and Newcrest would be, I think, just over 50 billion. And you think, wow, that's, those are big companies. But when you compare them to other industries, the total size of our industry and the market caps of the largest players in our industry really pale in comparison. And we hear that, and I think we know that size improves liquidity, and that size and liquidity do drive or do contribute to prices going up and better trading multiples than if you have a more thinly traded stock. And it allows the larger pools of capital, like the generalists that we've talked about, to really more easily come into and out of a name when they need to, without moving the price one way or another. And so the size of our the companies in our industry actually ultimately does matter, I believe, in continuing to attract pools of capital into our space. The other thing that is always interesting and exciting about consolidation in our space, and I think you've heard a lot of talk that more consolidation is needed in our space, that there's a lot of fragmentation and so on. But when we do have consolidation, we also have some fragmentation, and new companies are created when companies that get together like these two, when they look at their capital allocation and maybe make determinations that capital might not be allocated to either some of the operations on their platform or some of the development assets or exploration assets on their platform. And then we see a consolidation, optimization of a portfolio, and then maybe the creation of larger mid players as they take advantage of these consolidations and an optimization of allocation of capital.
I think definitely it's going to be an interesting one to watch. We'll see how that goes. As we are finishing up today, I wanted to just get your thoughts on some of the larger consequences when we see times of slowdown in terms of financing in the resource sector. Obviously, we can tell that maybe the most obvious effect is that companies can't move forward as quickly. But beyond that, what are things that we should be aware of and people should think about?
Yeah, I think that's one of the critical one. Of course, we've heard the expression in our industry that all the low-hanging fruit is gone, and maybe that's the case in the gold space where there's been maybe more capital allocated towards that. Just to give you an example, in the gold space, on the theme of maybe all the low-hanging fruit is gone, S&P put out some information around discoveries in the gold space over the last 30 plus years. And they estimate that there have been around 330 discoveries between 1990 and 2021 or so, and in the gold space. But out of these, only 29 of them were actually found in the most recent decade. And so, certainly on the theme of all the low-hanging fruit is gone in the gold space, that's putting some statistics and some data around that. In terms of less capital being allocated in the space, and we're seeing a lot of discussion now, around critical metals, where governments are more focused on energy security, energy transition, just energy. There is capital being allocated by automakers, even by governments, to getting some companies that have assets that are really at the development stage and are trying to put financing packages together and to get those across the line. But we're not seeing capital necessarily being allocated at the more riskier part of the life cycle, and that is at the exploration stage. And so pools of capital that will take more risk in that value creation and that have a longer time horizon, the attraction of that type of capital is really important in our space. Sometimes I talk about the mining industry being similar to the healthcare industry or the drug industry, and people look at me a little bit funny. But we're talking about allocation of capital and taking on risk, where maybe 1 in 5, 10, 50, 100 are ultimately going to result in revenue generation. And that type of capital allocation and risk for reward, and also the time horizon, because it now takes 15 plus years from discovery to revenue generation in our industry. It probably takes the same amount of time to get a drug from the earlier stage to, the shelf. That type of time horizon and different capital players coming in at the different sort of life cycles, where you might have a different risk reward balance, is really, really important. And of course, we're not going to achieve energy transition, energy security without the critical metals that have all been identified in the various in the various critical metals lists that we see from Canada, from US, and from other countries around the world. So making sure that capital is available at that early stage is really, really critical to make sure that we can achieve these goals that we've set out for ourselves. Again, particularly in the base metals, critical metal space.
Okay, I think you've given us really so much to think about. Thank you for going through all of that. It was great to have you on to go over financings in the resource sector.
Thank you very much for the invitation, and I really enjoyed our discussion.
Great. Well, thank you very much. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Daniella Dimitrov.